Have you been thinking about buying TSLY, stock ticker TSLY, or some of the other YieldMax ETFs? Well, watch this video as I get into how they work, and maybe you'll have a second thoughts into that. Good afternoon. My name is Adam Kahn, and I'm the Rational Investor. Today is Wednesday, November 29th. I hope you're all doing well. Before I get into the video about TSLY and how that fund works and whether you should be buying it or not, do me a favor if you haven't already, hit that subscribe button, smash the like button, make some comments about what you think, where I'm wrong, what's going on in your lives, and why you think things are good or bad investments. I love the conversations. I'm also going to put a link in the description on opening an account at SoFi. I use them as well. If you use the link, they're going to give you a free $25 if you deposit $10 or more. And they're also going to give me a small gift in an account that I share with my son. He's 13 years old. I try to teach him about investing as well. So it's kind of cool. Whenever there's a deposit, it gives me an excuse to kind of talk about some of the stuff with him as well. So I want to talk about TSLY today. It's been in the news a lot. And I know a lot of people are excited about it because of the dividend yields it gives. But I want to be a little cautious about investing in it if you don't understand what they're doing. So I'm going to kind of explain that in this video. Now, keep in mind, you guys need to do your own research for what you think is a good investment for you and not listen to me other than just these are my ideas. You don't have to follow them. I am not a fan of TSLY. That does not mean that you guys can't like it or invest in it for yourselves. You need to seek your own financial advisors, do your own research, and make those decisions for you. My reasonings are different. So, let me explain how the fund works. And to start, I'm going to explain what being synthetically long using options means. So, I've watched some videos where the guy who runs the funds has talked, and I've also read the prospectus. They do not own Tesla stock. And it's the same with the other funds that they run. They have these YieldMax funds that they're called. And what they do is they sell a put. When you sell a put, if the stock goes lower, it commits you to buying that stock. And then they buy a call, where that means if the stock goes higher, they own the stock as it goes higher to be synthetically long. So if the stock, we'll use Tesla, was around what, 245 is about where it closed today. So if they sell this week's 245 put, they're long the stock if it drops below that. And if they buy the 245 call, they are also long if it goes above it. That way they don't have to actually put up the $25,000 to buy 100 shares. They collect the premium from selling the put, and they pay whatever it costs to buy the call that might offset each other. So they haven't had to put a lot of money out of their pocket to be long the stock. They then sell a weekly call against the call they're long to generate what they're calling dividends or the yield from the stock. So maybe they sell a 250 or 255 or 250 weekly call option. That limits your upside potential in the stock, but you have the full risk to the downside if it falls. The other thing that I heard him talk about that gives him an advantage in his mind is if the stock goes lower and he wants to get out of that call option and take the profit that he made and then sell a lower call to generate more yield for the stock. So let's think about that for a second. Stock's at 245. As an example, let's say he sold the 250 call. Stock drops to 235. Great trade so far. So what they might opt to do is cover that 255 call and then sell a 245 call to get more premium. The problem with that is if the stock reverses and starts going higher, they continually lower the amount of ability to grow on the upside by continually trying to drive more yield by selling lower and lower calls, so that when the stock eventually starts to go higher, they've offset that ability to make a profit from that by selling lower calls. Again, you still have the downside risk by being short the put. So as the stock falls lower, you are going to be long the stock, and you're just going to continue to sell lower and lower calls to mitigate how much money you could potentially make on the upside. You have more and more downside risk and limited upside risk. Now, I want you to understand also when they give a distribution on a dividend, let's say it's a 50% yield, so to speak, throughout the year, but we'll call it 41 cents. When they distribute that 41 cents, the value of the stock you own will also drop 41 cents. Dividends are not free money. Not only are they not free money, there's no guarantee to them. They can be cut, they can be lowered, they can be cut completely. The fund is essentially just trading stock options, and in this case, weekly Tesla options, with a net short position in the hopes that the stock that they can drive enough revenue from selling the premiums to offset what I think they're probably going to lose in the value of the ETF. I see it as a really dangerous strategy. And a lot of people are seeing it as a way to drive income because they're getting these large dividends. Please be careful. Again, do your own research on it. But I don't see it as a good dividend stock. I see it as a risky options trader. So you really have to trust that they know what they're doing. And forgive me, the only person I trust that much to manage my own money is me. And what I'm really encouraging is I'd rather see you guys do it. Now, again, you need to make your own decisions. But if I want to try to drive the equivalent of a dividend through Tesla stock because I think the stock is going to go higher, I would personally rather buy the Tesla stock and sell covered calls against it to generate some dividend or income from it. I sure don't want somebody selling puts and buying calls to sell additional calls above that, offset my upside potential, and continue to sell lower calls when the stock goes down in price to give me a higher yield. Because the higher yield they give me is just coming out of the value of the ETF. If I put in $10,000 and they give me $5,000 back the next week, well, I'm going to only have $5,000 of value left in that stock or ETF in this instance. So don't see it as free dividends. It's just money coming out of the fund to you that they're then having lower value of the ETF. It's a really risky ETF. Now, the reason that the Google one and the Amazon one and the others don't pay as high a dividend is it's got lower volatility. Maybe they've had better success with them, and lately the stock market's been rallying, so their positions should work out. But I see people who are leveraging because they're seeing these dividends as pretty much guaranteed revenue to pay off the leverage. Uh, I just see that as a really risky way to live your life and really dangerous investment. So do yourselves a favor, read the prospectus, understand exactly what they're doing to generate these revenues, and maybe it's not as safe an investment as people seem to think. The other thing that really bothered me is when I listened to the guy who runs the fund talking, he used an awful lot of double talk that I find was probably on purpose to confuse people, to imply it's a better investment than it is. He talked about how dollar values drop if percentages go higher, and if the stock price drops, you might get a higher percentage yield. And the reality is that makes it sound like you're going to do better, but as the stock drops, you're going to get a lower return. If you're going to get a 50% return and the stock drops from a $10,000 investment to 5,000 and you're going to get a 50% dividend annualized, not each month, based on the value of the stock, and the stock has dropped, you're going to get a smaller return than it's implying. That percentage yield is based on the current price, so it's the current value invested, not what you originally put in. And the way that he was phrasing it, to me, led for a lot of confusion. And sometimes I think that stuff is done on purpose. Now, I'm not saying it is. I don't know him personally. I think they're good strategies to trading options against underlying equities. I really do. I use options myself. Again, you really have to be careful about it. And when I see what the fund is touting, like he kept saying, the reason he sells the lower options is the goal is to generate yield. He's not concerned with value. He wants to make sure the yields are high. Well, if you're constantly lowering the value because you're gaining yield, I don't see how that ends up being a winning strategy unless you're just really fortunate in how the stock moves. So anyway, again, do me a favor, give a thumbs up, like, subscribe. Feel free to tell me where I'm wrong. I know a lot of people really like these funds and are excited about them. My attitude is I'd be really cautious and I wouldn't put a whole lot of money in it. Again, just my opinion. Do what you want to do, because if it works out really well, I hate to be the guy that said not to do it. You need to make those decisions for yourselves.